Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending July 7th, 2023. Appreciate y'all tuning in to this channel and liking and subscribing to this channel as well as our podcast InvestTalk. Now, this week I'm going to title the video New Trends Emerge as Jobs Data Steadies. And we're going to dig into all of this here in a minute, but I'm Justin Klein, host of InvestTalk, and there's a lot to discuss this week, even though it was a holiday shortened week. I hope everyone had a good 4th of July holiday, but we had some good data. Manufacturing, this is the one I wanted to focus on most. It's the construction spending data came in, and this is really a sub category of that report, and this is manufacturing construction spending. Look at this, at a record high, ticked up another $2 billion month over month, but this is up 76.34% year over year. So that onshoring, reshoring is happening in a massive way, And this is underpinning, I think, the economy as a whole. Is just the jobs data, which we're going to talk about in a bit. It's just companies are reinvesting, doing a lot of capex in domestic supply chains, and that spreads across the economy. And I think that's something to continue to watch. And a lot of people don't focus on it. A lot of people focus on the housing market, and the new jobs market, new home market is relatively robust as well. But it's something that it makes it hard for the economy to get super weak when companies are investing in our economy. Now, next up, the durable goods orders. This is the excluding the defense spending, new orders year over year. That is starting to reaccelerate. What you see in the first half of this year, January, February, March, these are all negative prints. You had a negative print in November of last year, but you can see you're starting to reaccelerate the last 2 months. Now that's starting a trend, right? Year over year, where durable goods, new orders coming in are starting to accelerate to the upside. So that is also helping the overall economy. Now, there's a lot of jobs data this week. Usually it's on Wednesday. The ADP numbers on Wednesday. It came out Thursday because of the holiday, but it kind of it threw a curveball at the market, where the expectations for Friday's jobs number was right around the 200,000 mark, and this came in at nearly 500,000. And the market reacted in a big way. But what was interesting to me, I remember watching it, and the dollar didn't react in the same way. And so I'll show you that chart in a bit. But that was kind of a tell to what you actually got on the jobs number, which came in at, sorry, let me pull that up. There you go. It was this number, 209,000. Let's go here to get out of the noise. 209,000, which was right around market consensus, was that is a deceleration in job creation. And that is the lowest number in a while, right? 1 year, let's go back 3 years, really since COVID. Or I guess not COVID, but yeah, in the midst of COVID, January of 2021, we had negative, it looked like. Let me see. Yeah, we dipped negative. I'm sorry, that was December. Won't show up here, but it was negative in December of 2020. So, this is the weakest jobs payroll number in a while, and that's why you saw the dollar week, which we'll show here in a bit. But it's kind of a mixed picture. Unemployment claims that ticked up to 248,000, but still kind of in the range we've been at for really since March. Job openings, that one ticked down, but still relatively elevated. The ISM new order index, that ticked up to 55.5, so that's a bit of a positive. Services, prices paid, this is showing inflation is ticking down, 54.1. That's the lowest level really since COVID. Pre-COVID, we were at 59, right? So inflation is basically dead if you really pay attention to the more near-term data. Average hourly earnings in the jobs number, that was flat year over year, or month over month, basically 4.37 to 4.35. Unemployment rate, that was 3.6, ticked down from 3.7. And so, the jobs picture is showing a tiny bit of weakness, but overall it's still relatively robust. You're not seeing a major change in layoffs. The quit rate is dropping, which is showing people are less ready to dump their jobs and jump ship to another one, which is showing general weakness in the jobs market. But that's coming off of a very strong base, right? You see this unemployment rate really been below 4% since the beginning of last year. Okay, and you're just starting to see a tick up, but it's very, very minor, right? Very, very minor when it comes to the grand scheme of things. So that was the economic data, but we're going to look at the market trends. And the first thing I want to show you is here is just the high yield master option adjusted spread. So this is basically a measure of the amount of yield you're getting for buying high yield bonds over treasuries. And right now it's at a 4.1. This is right around the lowest levels we've seen in a while, since February and March. Right, you had a tick up during the banking crisis back in March and April, and it's basically fully reversed. Now, that does mean that there's room now for another risk-off event, right? If this ticks back up closer to 5, that's more of a risk-off event. Still, 5 is not extreme, right? Let's go out to the 3-year. Even during COVID, it went up to about 9, right? So, and at the peak here in mid last year, went up to about 6. And that was relatively attractive for corporate bonds. But now you're still at 4, not that attractive, but room once again for it to move up. And it did move up last week from, let's see, 4.05 to 4.1. Still minor, but something to continue to watch. Now let's pivot over to the charts here. And the move index, that did get a big spike up on Thursday on that ADP number, and reversed a little bit yesterday. But I think the ADP number, once again, it was the market reacted big to it, but it was pretty minor. And I think that was all about, the Fed might become more hawkish, right? If they raise rates again, that's going to break the bond market. We've talked about this. It gets about 150, that becomes a big problem. It ticked up to 130. Still well below 150, so not big of an issue. We'll see if we can reverse all of that move from Thursday, and in all likelihood we will. But the Fed is looking to hike one more time, potentially this month. We'll see as more data comes in. We have the CPI data coming in next week, and that will be a big tell as well. Now, the S&P was certainly down this week, closed near the lows, and that was that. It wouldn't shock me to see this pull back to the 50-day moving average. We had a surge in the month of June because of all the whole AI thing. But there is some trends underneath the surface that I'm seeing. This is growth to value. All last year, I'll zoom out a little bit. All last year, and really since late 2020, values have been outperforming. And in a big way, it did last year, all through 2022. And this was more of a counter trend rally, but you're into resistance. And so far in June, you basically saw this trend sideways, right? And look at Friday's close, also weakness. So this, and look at the MACD starting to point down. This is showing that this momentum of growth over value is starting to wane. Okay, and you can see that in small versus large. Here's IWM to the S&P. So IWM is the Russell 2000, and you can see this as well. This is basically hasn't gone anywhere since the beginning of May. And so as last year you had small caps outperforming. You see this trend here up until basically March of this year, and then that started to reverse. Now you're starting to see the momentum reverse again, and I think small caps are set to outperform, and that means that growth side of the market is likely to underperform. Okay, so I wanted to highlight that little trend there. The NYSE, the broader index, that did have a pullback as well this week, but kind of in just a broad trading range. Neutral to bullish is how you definitely want to call it, because you do have a series of higher highs and higher lows, but in the short term, more medium term, you're just trading sideways, right? So nothing really much to glean from there. I want to look at commercial mortgage-backed securities, because this is an area that certainly should be on watch with major defaults, things like that. This strengthened, right? So not a big worry about the commercial market at this time. Broader 10-year, that did tick up above 4%. And obviously that should bring major tailwinds, or headwinds, excuse me, to multiples, especially for those growthier names. So that's part of, I think, the reason why you're seeing growth really peter out here. The banking index that has held in there had kind of a flat week, even though the market was down. So that's some strength to certainly like. Here's the SHYG to the SHY. This is short-term junk to short-term treasuries, and that started to roll over this week. So that is pretending maybe to a bigger risk-off event here coming up. Doesn't mean it has to happen, super soon, but it would not be surprising to see the summer become choppier. I think you're probably going to see that choppy environment, that maybe new trends emerge, and that's why I talked about this as being a market that's showing some new trends that are emerging, like that value starting to outperform growth, small cap starting to outperform large cap, and I wanted to highlight that. Let me actually go to the dollar. I talked about that a little bit before, and this was Thursday here. This second to last day here. This candlestick where the market was reacting to potential for a more hawkish Fed, and therefore the dollar rallied, but it actually closed near the lows. And then you had that much weaker ADP number that, it's kind of a lesson. ADP numbers, they come out, market kind of reacts to them, but they're very, very noisy, and they're often very, very wrong. So I don't really take any stock in ADP. I focus more on the actual jobs number that comes out on Friday. And when that happened and it came in at 209, near expectations, the dollar reversed in a big, big way. And that obviously gave lift to things like energy. All right, you had this bullish reversal in XLE. You had the USO. That one broke above the 100-day moving average. So oil is trying to get some traction to the upside. I think it's after the bell that the U.S. government has bought 3.5 billion barrels or million barrels to refill the strategic oil reserve. So that was something that I think will give the oil market another boost next week. And gold, it hung in there despite this kind of recent pullback. This looks like it wants to gain a little bit of strength. Okay, so I'm watching that silver to gold ratio also looking like it wants to reverse as well after this pullback for most of the year. So precious metals are starting to gain a bit of traction, which I kind of like. If you look at the broad materials index, that one also starting to gain some traction. Let me clean this up a little bit. There we go. And this one now above all the major moving averages and looks like it's pointed higher. The industrials, we talked about some of those numbers, that data near 52-week highs, and definitely much better than the overall market. And I wanted to highlight this. Here's XLI to like the XLK, right? Industrials to the technology, and you're starting to see that after all this year having a nice downtrend, meaning the industrials were underperforming technology that's starting to outperform like it did last year. So you're starting to see some trends that looks like the trends from 2022 are starting to reemerge in the markets. And that happens a lot, counter trend rallies. People still are enamored with the tech stocks and the AI craze and all of that. And then often marks at least the near-term top, and I think you've seen that in the technology side. So I really wanted to highlight that and show you the trends that we're seeing in the market that pretends to a second half that I think is going to be very different than the first half of this year. And so if your trades have been working in the first half of this year, you might want to reassess them and see what trends are starting to emerge that we just talked about that may mean your portfolio should shift a bit. So something to keep an eye out for, and maybe rebalance. And it's time to maybe rebalance your portfolio just a bit. All right. So overall, near term, I think we're actually going to see a little bit of volatility short term. What does that mean for the back half of the year? I still think we probably get some sort of pullback, maybe late summer. More concerted pullback, but it's more of, once again, a shift in those trends as opposed to a major risk off event that brings the S&P down 20-30% from here. Do we get a 10% pullback? I think that's certainly possible when we pull up the S&P here, right? So you're into some resistance. Do you pull back here into the 4,200 level? That's certainly possible. I think that's probably the area this is going to be major support here. Think about this, right? We hit this level twice. This is really the breakdown area. So all of this is going to be major support on the S&P right around 4,200. Do I see us hitting that at some point this year, by the end of the year? I think so. But that doesn't mean we end there. I think we probably hit there and bounce higher and maybe close around where we're at now, maybe a little bit higher. So that's what I see for the back half of the year as these new trends emerge. And you have to be cognizant of that and know that you know these recent trends are unlikely to be sustained because of all the reasons we talked about, right? Higher inflation, higher interest rates, tighter liquidity environment, all of that. So I want to thank you all for tuning in. I really appreciate all of your fandom, right, on our YouTube channel as well as our podcast, InvestTalk. And I want to remind you that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Thank you all and have a wonderful weekend.